Good morning to everybody. Nicholas Borneos of Capital Link. I'd like to welcome you to the second day of our forum, the 16th Annual International Shipping Forum that we are hosting together with Citi. So Chris Wetherbee, our partner in this conference, is going to moderate this panel. And we are delighted to have with us the CEOs of major container shipping companies. I will let Chris introduce George, Evangelos, Aristides, and Constantin. Container sector is one of the sectors that are doing spectacularly well. Tremendous link in the global supply chain. So Chris, the floor over to you. Thank you.
Great. Yeah, thank you very much, Nicholas. Appreciate it. Appreciate the opportunity to work with you again. And we're really delighted to host the container panel. As Nicholas said, this is a really interesting part of the market, and I think one that investors have a lot of interest given what we've seen with the strength and the outlook and what we've seen in terms of impacts on the supply chain over the course of the last several years as we've gone through the COVID pandemic and are hopefully emerging from all of that. So as Nicholas said, we have a great panel, with major vessel owning companies from around the world. And so, let's sort of dive right in. I think that probably is the best way to tackle what we have with the limited time that we have today. So maybe George, we can start with you. Would love to get your broad perspective on where we are, in your opinion, in the container shipping cycle. So I think that's probably the best way to start. We've seen significant strength. Capacity has been managed quite aggressively by the liner companies. We've seen rates elevated both on the Baack side as well as on the charter side. Where are we in the cycle? How much longer can this go?
Thank you, Chris. Well, I think that if you had asked the question a month ago, I would have told you that when we're in a great position of the cycle and the cycle keeps on moving. The only caveat I would make today is this Ukraine war that has derailed a little bit the cost of energy and probably added a bit to the already expected inflation. Now, with that in mind, we see that some liner companies are taking a wait and see stance. Nothing has changed in the fundamentals, but it's psychological. When you see all these things every day, day in, day out on the news, and psychologically, people want to see, okay, let's wait to see how this is going to be resolved before we press on the pedal, the gas pedal again. Fundamentally now, which is always the important thing to look at fundamentals, the congestion has eased in some ports a little bit, but now we see new congestion coming from China with this COVID outbreak, and the order book is it's quite substantial, but it's not substantial into the sectors that the people in this panel have ships. I mean, in our ships, where we mainly look at ships below 10,000, if you deduct from the order book the scrapping for any ship going at 25 years plus, more than 25 and more, the order book becomes around 2% net of scrapping, which is for the total order book. This is for the whole years, 23, 24, 22, 25, all of the years, which is nothing. It's fundamentally, and that is without taking into account all these issues about slow steaming that are coming in a few months.
Okay, yeah, that's a pretty optimistic outlook. Maybe Evangelos, we could get you involved here. What's your perspective? Do you share that same opinion, particularly as it pertains to the order book? Because we do see it as a fairly large number, but I think George makes a good point about the relative scrapping potential. If rates remain high, will people scrap their vessels even if they're that old?
At this point, we are fixing 25-year-old ships, feeder container ships, at $30,000 a day for 3 years, which is a spectacular number that we have never seen before. But the issue with the order book, I will agree with George. We believe the order book is very manageable, to be honest, because if you remember in the past peak of the super cycle in 07, 08, the order book was like 60% of existing fleet. It's now at 23, 24%, and it's skewed towards the larger sizes, yes, which will of course involve certain cascading. But if you there's a few things happening. We're going to see slow steaming, definitely, by anywhere between, our view is 1 to 2 knots starting next year. You have energy prices that are elevated. We don't expect these prices to come down soon. That's a further incentive for liners to further reduce speeds. If speed reduction absorbs 10 or 15%, even with no scrapping, which is not a very realistic assumption, of course, but even if you go to the extreme, the demand for the next years, even if you go conservative, should cover the order book. So we don't expect to see an imbalance as a result of ships delivering. Will there be a softening? Yes, there will be, but it's a different thing going from a Panamax being able to earn today $50,000 to $60,000 a day for 3 to 5 years. It's a different thing, that number going down to 40, which is still a very healthy number. And it's totally different than what we were getting 2 years ago, which was 8,000 for 6 to 12 months, right? So maybe, and there are concerns, as it was mentioned, with the Ukraine war, with the energy prices and the inflation, but ultimately this is going to lead to a recession. No one can pinpoint the exact timing of all that, but we believe that in terms of fundamentals, we don't see something that can materially disrupt the market for at least the next couple of years, which is, we haven't been able to say this many times before, exactly because of the demand-supply outlook. So we're not worried about the order book.
Okay, got it. That's super helpful. Constantin, what's your perspective? I'd like to start off these panels getting everyone's kind of big picture, and then we can drill down into some of the specifics. Are you as bullish as George and Evangelos?
Well, I do agree with the gentleman that the order book is nowhere near what we've seen when we entered 2008, 2009. What I think is, maybe just to add some additional perspective, whilst I share most of the opinions that were just mentioned. The difference is, I think, the composition of the order book, and obviously not just in terms of size. That's I think a common knowledge in terms of very much geared towards the large vessels. It's also who has ordered the ships and who is the actual who is the party behind the orders. And there, in my view, it's very clear that the larger vessels have either been ordered by the large liners or chartered back by the large liners. The smaller you go, the smaller the order book in relative terms and in absolute terms. And also you see quite a difference in terms of who has ordered. This has mainly been done by intra-regional operators, mainly intra-Asian operators actually. So whilst the larger ships are LNG dual fuel types, the propulsion, the fuel availability on the main lane trades, where the vessels trade today, tomorrow, and the day after tomorrow. For the smaller vessels, it's way more challenging because they are the flexible part of the supply chain, of the value chain on the ocean. So a lot of, if you look at the top 10 liners, with the exception of Evergreen, actually no one has ordered. So that is very interesting, and I think that is what is important to note, because the smaller vessels have always been available in the charter market over the last 10, 15 years. That has now disappeared because most of the vessels have been chartered in for prolonged periods. So the charter available pool of vessels is very, very limited, especially in the smaller vessels where it's usually a higher proportion. So I think this will be a very decisive factor for a sustainable charter rate environment across sizes, in my view. And in my book, we will also see the first real green trades on intra-regional trades or coastal trades, simply because the fuel availability of, let's say, green fuels will not be that available on the main lane trades, but more on coastal trades. And I think this has to be seen in addition to what Evangelos and George said on the order book. If you look at the intricacies of the order book and the different sizes and who has ordered and what is the driver behind people not ordering or ordering.
Okay, understood. Aristides, want to get your perspective on this as well. So in terms of the cycle, again, are you as bullish as the other panelists here? And is it focused on the smaller vessels like what we've heard so far?
Well, yes, we are focused on the smaller vessels anyway, and the picture is quite clear there. The order book is extremely limited on the small sizes, and the fleet is very old. So that those dynamics are there and are unchangeable. And as George said at the beginning, if you asked me a month ago, before the Ukrainian war, I would have been extremely, extremely bullish.
Yeah.
Now I realize, and I hear all this discussion about a possible recession. I think the next 1 or 2 months, we will see really how this thing evolves and will give us a much clearer picture. I think for the next 1 or 2 months, what we can expect in the market is for it to be quite quiet. Everybody is waiting to see how things will develop. We are also waiting to see how things will develop, because at the end of the day, we do depend on the demand, on the global demand, and this is at the pause stage right now. The supply side is very positive, especially on the smaller size vessels. The demand size, to me, is an unknown, and we're waiting for that, to see how that develops.
Okay. Yeah, no, that's a great point and a great transition. What I wanted to talk about next was the demand side. So I think you all sort of touched on it to some degree, but obviously I think Aristides put a little bit of a finer point on the idea that there are some concerns. We have, extremely elevated inflation, particularly here in the United States. We have a war in Europe, which has some potential dampening impacts on consumer sentiment and the potential for spending as we move forward. Maybe George, when you think about these factors, how does that influence your view about, sort of overall demand as we think out over the course of the next, couple of quarters or so? Is it the type of thing that you need to wait and see because there's just too much uncertainty, or is, the health of the U.S. consumer still quite good, and maybe we get some optimistic outcomes in the next couple of weeks, hopefully, out of Eastern Europe?
As you know, demand for consumers has to do a lot with psychology also. So right now, people are worried. Once and if this conflict is resolved in a manner that will no longer create a question mark in the heads of people, then we might see the effect of a bottleneck. Right now, they stopped. If they stop ordering goods via the internet, people, or if they, if they're more cautious, and then they feel, oof, this is past, then we might see a surge in demand again. And especially if this pause has been for like a couple of months or 3 months, then we might see an increase. I don't think that there is a big issue about demand going forward. I don't think the economy has an issue. But for us, it's one thing, the demand. The other thing is supply. I think the story that I believe at least, is more of a supply story, which is not that relevant to demand. And I think the liner companies are doing the right thing. They're fixing forward the contracts. They're making sure that the freight rates are kept healthy and high. They're managing capacity. And the order book, as we just discussed, is not creating any questions on the sizes that we employ ships. And there's also one thing to remember. The cascade effect that used to happen because of the CII calculations cannot happen to the same extent this time around. And we can go to this later if you want in more detail what I mean by that. So I am relatively bullish on the market.
Okay, that's helpful. And I guess, Evangelos, when you think about, what George said around demand, and I think that's probably fair. This is as much a capacity or supply issue as it is anything. When you think about the factors that are out there, how does that influence the availability of capacity? And I want to maybe specifically focus on, sort of China's zero COVID sort of policy in terms of, turning on and turning off, locking down and opening back up. We know that we've seen some things about Shanghai, although ultimately it sounds like the ports are open, but it doesn't seem like everything supporting the ports are open. So when you think about those types of dynamics, the congestion that we've seen at various ports around the world, how much capacity do you think is being stripped out by sort of these, anomalies in the market?
I think at this point, I read a statistic recently. It's something like 30%.
Okay.
Right. And you have event-driven issues with congestion, like what you discussed or what you described in China with COVID and the shutdowns and the zero tolerance policy they have over there. but it's also structural. You know, in LA and Long Beach, you have 40% of US imports passing through those port facilities. And 30% of US exports go through those ports. And it's not just the ports. I mean, maybe now congestion has eased a bit, but the whole supply chain through the last mile delivery is strained. You have issues, you don't have enough trucks to carry containers. You know, we used to have a container ship discharge in 2 or 3 days. It now takes 2 to 3 weeks. You have containers piling up. There are not enough trucks. You don't have enough or big enough distribution centers that receive the goods, and they cannot allocate them quickly enough to the supply chain. I mean, it's a whole, look, this whole e-commerce thing where people just click on their phone and they expect to get this next day on their doorstep. It may sound very nice and very efficient, but there is a lot of background to it. And it's not just ships and ports, it's the whole supply chain that has been strained. And maybe with COVID, this was sort of exacerbated a bit. But I think that we would anyway have moved towards this direction, right? And these things are going to take a while to correct themselves. This is why I don't see all of a sudden this thing normalizing in 3 months, because that would be not such a good scenario as it relates to freight rates and charter rates and what have you. I don't see this being fixed anytime soon. So,
yeah, so Constantin, maybe let's pick up there. We all see the LA Long Beach numbers, and those are very, those are the very obvious impacts of congestion, and it's what, investors talk a lot about. But, when you think around the world, I think there are other limitations from a capacity perspective, and you see congestion in other parts of the world. So when you think about that, are there other things that you're looking at specifically outside of LA Long Beach that influence the availability, like how many turns ultimately you can get out of your vessels, and how much utilization they're able to provide to the market?
Yes, I mean, first of all, I share the number that Evangelos just said. So it's around 25 to 30% of the fleet that is kind of inefficiently utilized. Let's call it that way. I think more generally, LA Long Beach is the most prominent one, and people look at the numbers. But obviously, part of the recent reduction is certainly due to kind of the aftermath of Chinese New Year and the Olympics. And we already now see that upcoming TU schedules actually suggest that there will be a capacity increase again on Trans-Pacific and Asia-Europe, which in turn is likely or will likely lead to an increase in congestion. This at least is a strong indicator for further arrivals. So my expectation is actually that we will see an increase over the next couple of months again in LA Long Beach. To your other point, in terms of other areas on this planet, we mentioned Shanghai earlier. The implications remain to be seen over the next couple of days, weeks, and the zero COVID policy might lead to further disruptions if continue to be carried out in China. And then obviously, I guess very importantly, actually, we have in the US also the hinterland concerns and issues that put constraints on the supply chain. And even on the East Coast, we now see quite some delays and congestions, right, in the US. And lastly, but not, and very recently, actually, we have seen the first implications of the Ukraine-Russia conflict in the Baltic, in Northern Europe, in the Med, where we already see delays in ports there, which will in turn, lead to further disruption and delays in the supply chain. So if you look at the Clarkson's index, for example, the global port congestion index, it's very close to all-time high. The Kühne-Nagel index suggesting the same. So it's probably different areas, but this will not be over anytime soon, as far as we can see from the data that we analyze, because it's not just a LA Long Beach issue, although that is obviously on the front page. It's other areas as well that actually are concerning in my view.
Yeah, okay, that makes sense. And so, Aristides, when you think about it in that context, with some of the sort of impacts to utilization across the globe, what do you hear from your customers, the charterers of these vessels, in terms of, how much capacity they think they need going forward, and maybe if it does change their perspective on how much chartered in capacity they want to have versus owned capacity? Is there a discussion around that as well?
Well, as I said before, I think there is a slight pause right now on charterers on taking vessels on charter, especially what has disappeared recently is the, short-term charters because of all this disruption and these uncertainties. However, there is so little vessels available for charter at this day because everything has been fixed, so that when one or two vessels come open to be fixed, they do get to find employment, and the charterers continue to go for long-term charters, because I think everybody agrees that the long-term prospects continue to be good. So nobody wants to pay, the $200,000 a day today to take in a vessel. But if it's getting a vessel, at $40,000 a day, a Panamax vessel for 4 years, that, there still could be interest in that. So just because there are too little vessels available. So I think the consensus is, let's wait and see. We might have some difficulties now, and okay, we have these extra congestion issues that are being caused in China and in Europe as well. But as things clear up, and we are eternal optimists, not only on the container sector, but as people, and that's what we should be. We should be optimists in this world. We do hope that this problem with the Ukraine-Russian war will be resolved relatively soon somehow, and the fundamentals will continue to carry us on into a strong, end of the year and onwards.
I certainly like optimism, and I am an optimistic person in general, so I think I can appreciate that. I think we all should share in that, particularly at this time in the world. So, George, want to get your perspective on the charter market. What do you think how do you perceive the depth of the charter market? So picking up on Aristides' point around wanting to go longer to be able to offset the potential spikes we might see in shorter term rates, from an asset owning perspective, what are the opportunities you see out there? Do you want to go long? Are you sticking in some of an intermediate type of term? How do you think about that?
Well, I'm a conservative person when it comes to commercial activities, and we take the view that it's better to have long-term employment at lower levels than to play the spot market over 3 months. That's in general how we view things. Now, we see that right now what's happening is what Aristides said. So the charters are there to take ships for 3 to 5 years, depending on the size of the ship. And that's what we will continue to try and achieve, longer term employment. Because this is the nature of our business. It's the business that we supply services to these large logistic companies, the liner companies, and they also want to make sure that they have, because these guys are taking the long-term contracts right now, so they want to make sure that they have the capacity committed so they can serve their contracts. Lately, we have seen a lot of sell and purchase activity from liner companies buying ships. And this has created issues between the liner companies. When they have a ship that has been normally would have been extended, and that ship has been purchased by a competitor, so then they lose the ship. They know that they will lose the ship, and that creates issues, and they're looking for a replacement and so on and so forth. So this has created disruption within the chartering activities and the market for liner companies. The fact that a lot of ships have been purchased by liner companies, something unusual.
Okay, that's helpful. And Evangelos, from your perspective, how do you perceive it, and what's the approach that you're taking? It seems, this has been a favorable market for ship owners, and so there's probably been opportunities to adapt your portfolio to some degree. What's the approach that you're taking?
No, we have also adopted a pretty conservative commercial strategy where we can. We fix long. We believe these are super healthy rates. There's no reason why you shouldn't lock in 5-year tenor at, let's say, $60,000 a day, and instead speculate in the short-term market. And with all that's happening, there are many uncertainties out there, right? With the war and the COVID and the new variant and what have you. So we have a very strong charter backlog at $2.8 billion for the next, with an average charter duration of 4 years, which practically insulates us from any sort of ad hoc event that may lead to some sort of disruption in the market, provides our investors with clarity on cash flows. We have great visibility to plan for things ahead, like for ordering new buildings and these sorts of things. So it's a much sort of straightforward position to be in, rather than, and we were never set up to speculate the spot market, especially on the larger size ships that we have. And in this market, our customers also, as George said, want to commit these ships for longer periods because they want to have certainty of use of the asset, because this is a tool for them to execute their business. So that's where we are.
Understood. Constantin, not sure if you have a different opinion. If you do, about sort of the charter opportunities out there, would love to hear it. Would also really like to understand what you're doing with the capital. This is I don't want to call it a windfall per se, but this is obviously a very highly profitable period of time for asset owners. So how do you think about putting capital to work in this market?
Yes, and first of all, I share the conservative view of the gentleman, the previous comments here. On capital allocation, I mean, we have a very, very clear view, and we have been quite open about it. We have a very clear focus on returning capital to investors in this time of the cycle. We have obviously, built our portfolio in what I would say a fairly low market environment, taking more employment risk and lower asset prices. And now, obviously, you have the opposite. You have hardly any employment risk and higher asset prices. So for us, the clear focus is now to also return capital to investors. We have set out a policy by dividending out 75% of net profits as a recurring dividend. And in addition, to the extent we sell vessels, which we have done, we have also bought vessels last year, but to the extent we sell vessels, to also look at extraordinary dividends or potentially share buybacks. We have already, in the first quarter this year, paid a dividend of around $200 million, which is very significant, being event-driven and recurring distributions. We will definitely hold up to that on a quarterly basis to pay that out. But that still leaves enough room for two reasons when you look at our very company. One being we have very low debt. I mean, we basically have to have net debt zero end of this year. So we want to maintain flexibility in the balance sheet too, selectively. But if the time is right and if the opportunities are right, also potentially do fleet renewals. That is definitely also something we consider, but only and to the extent we can actually mitigate residual value risk. This is how we started. This is how we will continue to act rationally in taking selective growth decisions. So potentially also to grow, but only if we can de-risk the investment, meaning by concluding a charter simultaneously. That applies for both second-hand vessels as well as potentially new builds. And I actually believe that these kind of deals are available, and we are working on quite a few, and therefore clear focus on distributing capital to investors, but without losing flexibility from a balance sheet standpoint.
And can you give us an example of how you would mitigate that sort of residual risk? How much duration do you need? And let's say it's you can give us an example, whether it's a new vessel or a secondhand vessel, how you think about that. How much tail risk are you willing to take when you think about those dynamics?
I mean, it obviously also depends on the technology question, right? If one was to order a conventional propulsion vessel that potentially has the ability to be methanol ready upon further capex investments, then, you know, over a 5-7 year charter, that would need to be de-risked to scrap or close to scrap, and that, in my view, is a very attractive proposition. And I would argue these kind of deals are available in the market. They are not out there on a daily basis, but those are deals that could be done. And the next step is obviously on a second-hand vessel to make sure that you can simultaneously conclude a charter. And I mean, second-hand vessels are valued at scrap plus 3, 4, 5 year EBITDA, depending on the size of the vessel and the term that you can get. So the market is very efficiently actually valuing second-hand transactions. So that would need to go hand in hand. So if one was, at least in our seat, if one was to buy new vessels or second-hand vessels, that would have to come with a charter attached that significantly de-risks that investment over the initial charter duration.
Got it. That's very helpful. Aristides, how do you think about deploying capital? What are your, you know, what's high on your list in terms of putting money to work?
Sure. And firstly, I would agree with your comment initially. It is a windfall, really, what we're seeing today. I mean, it's a lot of cash that the liner companies are making, but also the tonnage providers like us are making. So it is a lot of liquidity. And the big question is, how do you deal with all this cash that you are accumulating? We are a little bit more aggressive, I would say, than Constantin is in that we want to continue growing the company, and we are taking this opportunity to grow the company. We've ordered 7 vessels, which is close to 50% of our current fleet. So these 7 vessels at prices which, in today's market, if the charter rates of today's market existed, we could pay them, bring them down to scrap in 3 to 4 years. Of course, we cannot fix the ships right now, but in a year's time, we will be able to fix them out, and we're hopeful that we will be able to do that and recover a whole investment, you know, in less than 5 years. That is a fantastic return for an asset that still will have about, you know, 20 years of life. I expect that the conventional powered vessels will continue to be around for quite some time, obviously. So we are a little bit more aggressive in that. We're deploying our capital both to new builds, but we've also bought a couple of second-hand vessels with a charter attached, which brings them down very close to scrap at the end of the charter part. So minimal downside risk, potential upside risk, depending on how the market will develop in the future. So we're putting quite a lot of our capital into growing the company, and we will commence a dividend program, but it will be a very decent dividend, not giving out 75% of our income, but it will be a much smaller number than that. We want to reward our shareholders, but we want to continue taking advantage of opportunities that we really do believe still exist now to grow the company for the benefit of the shareholders, of course.
Okay, we have some questions coming in from the audience that I want to make sure that we give time to as well. So maybe George, this one comes to you. With time charter rates so high, is there any concern about counterparty risk? And maybe more broadly, how do you approach managing counterparty risk in your portfolio?
Well, the question is the counterparty, obviously, in its case. We select very carefully our counterparties, and we make sure that we do not take unnecessary counterparty risk. And that is the first concern we have before chartering a ship out. We have there are a lot of commercial, let's say, secrets. I don't know what I can say, but we have taken some of the ways that you know our industry mitigates counterparty risk is we get a charter, and then we agree the first couple of years to be higher on the charter rate and then lower on the tail end, so we receive faster the you know during the years that we know that the income of our counterparties, if we have questions about them, can speed up the amortization of the charter hire. Or there are other ways, such as receiving some charter hire in advance and keeping it in a locked in a bank account, and then slowly feeding the charter rate going forward. So the charter rate. So there are various mechanisms that each and every one of us is using to manage counterparty risk. But of course, the initial thought is that the counterparty has to be, really solid, and we look at that rather than try to reinvent the wheel, let's say, in this way. Let's not forget that the liner companies, after this couple of years, they are totally different companies than as a counterparty risk respect. With this respect, they have reduced their debt to almost zero. Their net debt probably is zero of all the liner companies, I would imagine, and more. So they're cash flow positive with zero debt. So these companies are companies that I don't see them as they used to be 3 years ago with respect to risk.
Yeah, no, that's a very good point, and I think that's very well said. The credit profiles of the liner industry have improved dramatically, to your point, and are probably in net cash positions in many cases, as opposed to being highly levered like they might have been several years ago. Evangelos, on that point, how do you think about your balance sheet in this environment? How is there any more work you want to do? How do you want to position yourself for, at some point there will be an eventual sort of deceleration in rates? So where do you want the balance sheet to be as we go through this very strong period?
Well, this goes to the heart of your previous question around how you manage capital, how you manage the windfall, right? And we have in the recent quarters, we've used all the tools in the toolbox. We've done share buybacks, we have reinstated the dividend, we have committed to continue growing the dividend, we have placed orders for new buildings, we have continued delevering. The old model where leverage of 8, 9, 10 times was the norm can no longer be. At least this is what our view is, right? And we're also bond issuers now, so we should have much more discipline on how we manage the balance sheet if we want to improve the cost of capital by way of access to the bond markets. So we are using, we're trying to optimize the use of capital. Our net debt to EBITDA is something like 1.5 times at this point, on the back of expected 2022 numbers, which is all contracted, by the way. It may go down even more. That's very healthy. And it gives you breathing room when opportunities come along. You have room to lever up, pursue new projects at a very competitive cost of capital, and be at the forefront of the new investment cycle, which I believe is going to come more towards the time when the new technology is available, the fuels are available, because that's the real problem here. It's not the technology of propulsion, it's availability of biofuels and what have you. So, we believe we're going to have one of the strongest balance sheets out there to pursue growth and gradually renew our fleet, which, by the way, the global fleet renewal and the Danaos fleet renewal is going to come over time, right? I mean, some people expect we're heading towards a cliff, and at some point, everyone is going to have eco ships. This is not going to happen. This is going to take time as infrastructure develops, fuels become available, and so on and so forth. People are going to start building the new, more eco ships, heading towards zero emissions in 10, 20, 30 years. So we are very comfortable that, the existing fleet for the whole industry is going to phase out naturally, but you have to be there with dry powder to invest in the future, right? if you want to maintain your competitive position. And that's what we're trying to solve for in this very good market environment.
Yeah, that makes an enormous amount of sense, and that's a great segue. One of the questions that came in from the audience is about regulations and what that might do to force owners to update their fleet. So Constantin, maybe for you, can you just give the audience a sense of the alternate propulsion backdrop and maybe what the potential opportunities might look like? Obviously with commodity prices moving around the way they are, natural gas prices moving around, there might be some thoughts around, some of these alternate propulsion technologies and how viable they may be or economic they may be. So can you give us some just broad perspective on that?
Sure, and that is obviously a session-filling question to answer, but I'm happy to give it a stab. And as I said earlier, I think the critical differentiator is larger versus smaller vessels and flexibility of those vessels and availability of fuels. I mean, technology-wise, everything is there, right? It's not a matter of technology; it's a matter of having the fuels where you need them. And there's obviously no a black and white answer to that at this stage. I think the easiest answer is for people to opt for LNG, because that's, at least in terms of the availability, that is where it is available at least. For all other fuels, we have looked at methanol, we have looked at ammonia, we have looked at obviously biofuels and even synthetic fuels. All of that in terms of quantity of volumes available, you are certainly not in the next 24 months, right? So any decision now on a new build or anything has to be taken against that background. And that's why, to my point earlier, if we were to go for conventional propulsion, we would always want to de-risk that investment, because you inevitably have a technology at the end of the road. It would still be a very efficient eco vessel, obviously. But if you look at the different options out there, I think there will be certain trades. We actually look with our customers at certain trades where you could run on methanol to the extent that methanol is available. And then we look at 2024, 2025, the earliest, to be frank. And on ammonia, I think there are still a lot of questions unanswered as to the safety and other concerns. So I personally think the answer is not there yet. I think everyone is doing their work, and there will be a few test runs, certainly on coastal trades, in my view, in the not too distant future. We've just heard COSCO ordering battery vessels, container vessels, actually to operate regionally, domestically. Also nothing that is delivered tomorrow, obviously. So I think that will still take time. I think one has to be, at least as a tonnage provider, and this panel is tonnage providers, we have to be very careful in taking technology exposure, since we're not the end user of the vessel, right? So I think that, at least I would assume, is a common and shared perspective. Obviously, together with our customers, we look at various options, and we are in very detailed discussions on that. But it has to work out, the technology risk has to work out, and the sharing of that risk and the upside has to be somewhat balanced. And I think that's also why you haven't seen that many orders from tonnage providers in the more innovative fuel technologies, if you want so.
Yeah, okay. No, that's very good perspective. I think it's a great point that you make about being not necessarily the end users of the technology, so limiting your exposure to technology risk over time and making sure that those decisions are a little bit more clear before you speculatively invest in various technologies. I think that makes a lot of sense from your perspective. So we're running short on time here. Aristides, maybe last word for you. We've heard a lot from this panel, and it's a very constructive backdrop with a little bit of uncertainty in the near term, right? And I think as we think out, though, it appears that there's reasons to be bullish over a longer period of time. So you've been doing this a long time. Maybe I could ask for some of your perspective relative to previous historical cycles. How do you feel about this? I know each one is different, and you're going to have different perspectives at different times in the cycle. But how do you think this sort of stacks up relative to other stronger periods of time in this market that we've seen historically?
Okay, I don't want us to be repeating, although it's a closing statement, so maybe I can repeat what we said previously. What is different in this cycle than the previous cycle we saw in 2005 is that we have an extremely low order book still, especially on the smaller sizes. So this is what is different. And I think this is what is going to help the cycle be long and the market to be good for quite some time if we avoid the recession that is in our thoughts today. So overall, very bullish. And the technology issues, one thing about that, all this new technology, it's coming, it will come, it will help us, but it's not here yet. I think before these things become commercial, we need another 5 to 10 years at least. So we will have to go on with existing ships, even building eco ships, of course, but with the traditional technologies.
That makes a lot of sense. I was just, while you were talking there, just pulled up the stock charts of each one of the companies on this panel, Global Ship Lease, Danaos, MPCC, Euroseas, and it's been, a very strong run. But I think as we absorb what we've heard so far over the course of the last 45 minutes about the potential outlook for the market, there's reasons to be optimistic. And I think that that's been, very clearly laid out by all the panelists. So, I want to thank everyone for your time this morning, kind of running through and laying out what is seemingly a very optimistic outlook for the next several years. And I see Nicholas has popped back on. So with that, I'm going to wrap up my part. I will hand it back to you, Nicholas. Thank you.
Well, all I wanted to say is thank you. Obviously, the container sector is one of the very top in terms of attention right now and doing very well. And this was a tremendous panel, as evidenced by the strong attendance we had and the questions you got. Thank you very much to everybody. Thank you.
Thank you.
Thank you.
Thank you. Take care.